The word portfolio manager means 10 different things to 10 different people. And there's all kinds of jobs that deal with portfolio management. It is something I've done almost the entirety of my buy-side career. And today we'll talk about what a day looks like in the life of a portfolio manager. Hi, this is Shalabh Garg, finance dad. I've had jobs on Wall Street my entire life, my entire career, most of it at a hedge fund. I've also worked at a bank, and I currently run my own hedge fund. And in today's episode, I'll talk about a typical day in the life of a specific type of a portfolio manager. Portfolio management, as the word implies, is about managing a portfolio. A portfolio of what? A portfolio can be of securities, of stocks, of Bitcoin, of real estate, at the heart of it, even Warren Buffett is a portfolio manager. He has a portfolio of all kinds of securities and stocks for the most part that he has managed on his own for better part of 50 or 60 years. At the heart of it, he's a portfolio manager as well. But the life in the day of Warren Buffett versus the life of a portfolio manager working at a hedge fund can be dramatically different. If you asked Warren Buffett on a random day, where is the S&P 500, where is a particular stock, he could not tell you in the vicinity of a few $100s because he just doesn't care. He doesn't have leverage. When he has bought something, he has bought it for the next 50 years or at least for the next 10 years. He's not even going to look at it until it's down a lot and he can buy some more. And why can he do all of that? Because he doesn't have leverage. He invests $50 billion of his money as $50 billion of investments. He does not invest $50 billion of his money as $100 billion of investment. That is what a typical hedge fund manager would do. So in a typical day where you may be like, not a lot has happened in the market, and that market word may mean multitude of things for you, stocks or bonds or currencies or whatever, that may mean a lot to a hedge fund portfolio manager because of that implicit leverage. We've gone into this idea of leverage into several of our episodes in the past, so I'm not going to get into the detail of it, but at the basic level, you're using $100 to buy $500 of assets. So if the assets move even a fraction of a move against you, the impact on you is magnified multiple times over. So the life of a hedge fund manager, portfolio manager, looks dramatically different than a portfolio manager who works in any other capacity. Warren Buffett is of course an extreme example, but a portfolio manager working at a PIMCO or a Vanguard or a portfolio manager, any portfolio manager that is exclusively dealing with investments that are unlevered, that particular person's day will look dramatically different than a hedge fund portfolio manager that deals with leverage and is determined to make money in all market environments. What do I mean by that? A hedge fund portfolio manager or an absolute return portfolio manager, their mandate is to never lose money. Now that sounds extreme, I know it does, but that is what the mandate is. That no matter what the stocks do for a year, no matter what bonds do in a year, no matter what gold does in a year, no matter what anything does over the course of a year, from January to the end of December, that particular hedge fund manager will put out an absolute return that is positive, and not just positive, but handsomely positive. Just the word positive doesn't mean that much these days because cash alone is giving you 4%, right? Interest rates have been coming down recently, but even today, if you buy a 12-month T-bill, it'll give you 3.5% risk-free. That means that you can put the money with the government, and at the end of year one, you'll get 3.5% returned to you. You'll have to pay tax on it, but before tax, you got 3.5%, no questions asked. So for the first 3.5 to 375%, a typical absolute return doesn't mean anything because you got that risk-free. So that particular hedge fund manager better have returned you 400-500% or 500 basis points, which is 4 to 5% above that risk-free rate for that investment for you to be interesting. Now, they are not doing that for free. That particular hedge fund manager is going to charge you an arm and a leg. They're going to charge you 2% of management fee and 20% of incentive fee. They're going to charge you a lot of fees for the ability to deliver that to you. They will deliver that through a variety of different ways. They will have expertise, they will have a strategy, they will have experience, they will have a track record. We've gone through all of that in the past, and maybe we will do that again in a future episode. But in today's episode, I want to talk about what does a day look like for a person like that, which is a person like me in terms of what I have done 20 of my buy-side career years. First of all, I have a lot of free time. I don't have busy work. A typical hedge fund manager or a portfolio manager does not have busy work. What do I mean by busy work? They're not moving things from point A to point B. They're not writing long emails to manage upwards. They're not writing long documents to explain something to someone. They're not presenting documents. I mean, they may do that if they have investor contact, but most of them are not doing that. They only have one mandate: to look after their investments, make decisions on what investments to make, and then to make sure they don't lose money. Now, that may sound easier said than done, but it's not. I promise you it's not. It is a lot of stress. It doesn't have busy work. I already said that. You don't have to sort of do anything from a minute to minute to minute perspective. So a lot of times you may see them doing sports. A lot of time you may see them playing squash or going to the gym or not being in part of big meetings, or just have this what seems like a lackadaisical life. A life where they don't have to do a lot. But I promise you, it is more hard work than any other job I can imagine. Why do I say that? There's a lot of research work. You're reading materials, you're researching your own trades, you're researching your own investment ideas. You're making sure that if you're losing money in a particular trade, it's not an opportunity to add, but it may be an opportunity to cut that risk for a minor loss or even a major loss, because something may have changed in that investment idea from the time you put it on. So the act that there is leverage makes it very path dependent, and because it makes it very path dependent, it makes it extremely stressful. And the amount of stress that a typical absolute return hedge fund manager wears, I believe, is equivalent the kind of stress that a basketball player, when she or he is playing basketball, or a fast car driver, Formula One driver, when he or she is driving that car, or a movie star when she or he is in the middle of a set and knows that if this movie does not do well, the next one may not be. I mean, not everybody is a Tom Cruise, right? There are people who are sort of middle of the road actors and actresses who are doing a great job at making a particular movie, but don't know if the work or the movie is going to be successful enough. Ultimately, they get paid because they're going to sell tickets in the movie theater. If a typical actress does not sell tickets in a movie theater, she's not going to pay. So when you look at Sydney Sweeney selling American Eagle jeans and creating revenue for that, that's why she can charge a portion of that profit as her fees, because American Eagle sold 300 million worth of jeans on the back of the advertisement she produced. The minute that stops happening the way it did for Brooke Shields in 1987 when she did jeans advertisement, and 5 years later that was over, she never made that kind of money ever again. So the talent business is entirely dependent on the talent that the person brings, and the hedge fund portfolio management job is no different. Coming back to the day in the life of a portfolio manager, a typical portfolio manager will get up early. I've always gotten up in the last 20 years at 3 a.m. in the morning. Why do I get up at 3 a.m. in the morning? Because at 3 a.m. in the morning, markets in Europe open up. And I want to see, just like when markets open up in the US at 9:30, what happens in Europe, because Europe is an important part of an investment of any portfolio manager. And I would ideally look at messages from salespeople that cover me from different banks. I would review them. I would see what positions are doing in Europe. Is there any particular economic data that has come out of Europe, or any important news that has come out of Europe that requires my attention? I will spend an hour doing that at 3 a.m. in the morning. And then I will try to go back to sleep. Sleep in the second leg is never as intense as it is in the first leg when I slept early leading up to 3 a.m. But I try to go back to sleep. And then I get up no later than 7 a.m. in the morning to see if there is some after effects of the halfway point of Europe and the beginning of the opening of the United States. And the markets are starting to slowly open up. Some markets are like stocks open up at 9:30, but bonds and currencies, they have been open a while already, and futures trade 25, I should say 5 days a week, so 24/5. So you can get some impression of how things are shaping up for the day. I look at the impact of those things on my own portfolio, whether I'm losing money, making money. If I am making money, where I'm making money, is there an opportunity to add to something or subtract something? Then I go into a morning call where I will listen into the economists. I will listen into other portfolio managers in the firm if they have any opinions about what may have occurred, and then I will talk to my own team about the positions. You generally will have sector specialists, people who look to, so I'm in charge of a variety of different things in my portfolio, but there will be individuals within my team that will look after little parts of that portfolio. A person who will look after risk, a person who will look after mortgages, a person who will look after credit, and I will talk to each one of them to see if they have any opinion, any feedback on their individual positions that they're looking after, or or any other item of interest that there may be. Generally that will go on until late morning. Then I will wait for the 9:30 open in stocks, wait for economic data that generally comes out at 8:30 a.m. Eastern time and has its impact on the day. Any political news in the last couple of years, as you know, political news has played an important role in financial markets. Any political news that may be coming out, impact of that political news, assessment of that political news, talking to political analysts, both at the firm and outside of it. By the time all of that happens, 11 a.m. rolls around. If I'm not working out, I will try to force myself to work out for an hour at noon. That workout is as much about health as much as about to manage the stress. Because if I'm down, then I don't want to feel too down on the day. If I'm up, I don't want to overreact to that profit and book profits early. And giving that hour to yourself where you're working out and taking a break from the intensity of the day is very useful, because I like to work out at Orange Theory. I've talked about that in one of my previous podcasts. I think it's a great way to relax and make and to deal with the stress. When I come back at 1 p.m., I don't eat during the day, but most of the people in my team would be having lunch either at the desk, or if they have a meal outside, they would be coming back from it. There would be a give and take of ideas in real time on the desk to talk about if they may have any ideas, if they may be looking to do something new. There's typically a few trades a day. They can be additive or subtractive to the portfolio, and those will be managed by the execution team, and I would work at that ideas with my team and with the execution team. That will go on. Generally, some markets start to close around 3 p.m., which is the bond markets. Stock markets close around 4 p.m., and it will be high intensity time between 1 p.m. and 3:30 or 4 p.m. And generally, the day comes to an end at 4 p.m. Positions get marked as the markets settle down, and the P&L gets calculated off the day. Based on the P&L of the day, new margin will have to be posted. Because it's a levered investment. So if the portfolio is down, then the extra margin would have to be posted to the banks or to the exchanges to make them whole on the loss of the day. And if the loss is too big within the day, they may even ask for margin intraday. So all of these things are very, very stress inducing. People ask me, what is the biggest challenge in this day or in this lifestyle? I would say dealing with the losses, dealing with whether they are mark-to-market losses or realized losses. Losses lead to you losing your job, and if you've done that 2 or 3 different times over the course of a long career, you will not be getting employed again. It is a typical talent business. You make 3 flop movies, you're not going to get a 4th one. You will have to pivot away from an actor or an actress job into something else. You have 3 or 4 bad basketball games, you're not going to get invited again. Same for football, same for investing, especially because time horizon for individuals letting you do this is very, very short. They're not looking for returns like Warren Buffett over the course of 5 years or 10 years. You let Warren Buffett manage a stock of Apple stock, but instead of an unlevered portfolio, make him manage the stock at a levered basis, where he has 2 times as much Apple stock as his assets. I promise you the decisions even the mighty Warren Buffett would make would be dramatically different than the way he talks, where he would talk about how I don't even look at the stock and I don't even see where it goes. He has the luxury of do that because he does not have leverage. The minute you have leverage, that changes entirely. And then on top of it, you have stop losses at a hedge fund, where if you're down 5% from the starting point of where you started the year, they will cut positions out for you. So you have to manage the path very, very carefully. Rewards are pretty attractive too. A hedge fund manager is not doing this job out of the goodness of their heart. They're doing it for the same reason as the basketball player or the football player, for the love of the game, but also to make money. If all of these positions and all these sports did not make the kind of money they did, it would not attract the kind of talent that they do, right? The reason that the talent gets attracted and then they bang their head against the ground every day, all these injuries and all of that is because of the financial rewards. And that's no different at a hedge fund. So what we have covered so far is what kind of portfolios exist, what kind of portfolio managers exist, what does a day in my own life look like doing that job. I'm sure it's a different story for many other people that do their job as well. One question I'm sure you're wondering is what kind of person succeeds in this job? And before I answer that question, I do want to lay it out there. I do offer a consulting hour. It's a paid consulting hour, so it's not for free, but a lot of people more recently have found it very, very useful. I can tailor their advice to you. You can reach me through the box below you through a variety of different means that we offer. It is something that you will find useful. My wife was asking me yesterday if when people hire you, what kind of advice do you think you can offer? The way I answered it is the best kind that there ever was and ever can be. Why? Because I have the experience of doing it. I have the unique vantage point of work experience combined with life experience that makes me unique in terms of the kind of coaching I can provide. But to answer the question in terms of what kind of person succeeds at it, the kind of person that can deal with ups and downs of P&L volatility, and the kind of person who's not afraid of taking risks. Those are the two necessary ingredients to succeed at this job. If you are scared of taking risks, and the risk doesn't have to be evaluated just through your ability of investing money. The risk can be, what did you do when two paths presented yourself in life? Let's say you were in love with this guy, and the guy seemed really risky, and you were in love with this other, you thought this other guy was very attractive too, but was absolutely not that risky in terms of what he was offering. In fact, was a medical doctor. Who did you pick? Did you pick the risky guy or the medical doctor? That's the kind of evaluation you have to do for yourself, that when given an option, do you place the high risk, high reward path, or do you pick the more time tested, straight path? So that's one. And second, once you pick that path, you better be ready to deal with the P&L volatility well. You're not going to make money. Roger Federer did this YouTube video, you should all watch it, where he talked about where a successful tennis player like him, he won over 65% of the games that he played, or I think even more than that. But of the number of actual points, how many points did he win? And he said he only won 53% of all the points that he won. So more than every time he had a point, half of those points he lost. And yet he went on to become one of the greatest tennis players in the world. So you're not going to win all the time. There's going to be P&L down days all the time. And the ability to deal that with a neutral emotional framework is really, really important. And that's the kind of person that will succeed at it. With that, please like, comment, and subscribe. I'm trying to grow my podcast, especially with the consulting hours coming my way. I'm really, really excited about it. I'll see you next time. This is Finance Dad signing off.